Hello all! Today we are very happy to have Harry Richards from Jupiter Asset Management. He currently manages the Nikko AM Dynamic Bond Fund, and we are very pleased to have Harry share his views on the fixed income asset class and how he is positioning his portfolio today. So let's start off with the first question. What is your take on the outlook for fixed income in the current economic climate as compared to other investment options like equities?
The investment landscape in fixed income has really changed over the last few years. We've gone from a very low interest rate environment to a much higher one. And we've come to the end, in our view, of the hiking cycle. And what that means is, as we embark on rate cuts, we should see the potential for capital appreciation in bonds of many different types, specifically in the government bond part of the market. And so when we compare it to other asset classes, what that means is our portfolio today has a yield of about 8.2%, and on average it's BBB plus rated. So if you compare that to equities over the long term, the S&P has had a compound annual growth rate of somewhere between 9 and 10% over the long term. And if you're getting close to that on an average investment grade rated portfolio, we think that's really compelling. The other point I would make is actually when you compare it to risk assets more generally, we see some earnings risk out there for the S&P, for the Russell 2000, for a number of the stock markets. And definitely there's still a potential debate open around whether we're going to go through a soft landing or a hard landing. And a hard landing would certainly not be great for equities. And so bonds we think are back. Bonds we think can deliver at least on par total returns with equities as we look forward into the future, and actually hopefully much more in the immediate term as we go through this period of uncertainty. And then when you bake in volatility, actually on a risk-adjusted basis, bonds should stack up really well in client portfolios. So this is one of the most constructive periods that we've had from Jupiter's perspective when thinking about allocating to fixed income products such as the Dynamic Bond Fund.
Okay, that's great to hear. I think earlier you mentioned the possibility of rate cuts. So may I ask, what is your view on the interest rates environments moving forward, particularly across US, Europe, and perhaps Australia as well?
Very good question. I think one of the things that's clear to us as we look across the key drivers of global growth, if we take China to start with, growth has certainly not been coming in as strong as many would hope, and there's had to be quite a significant amount of intervention already to try and prop up things like the equity market and the property market. When we look to Europe, we're certainly seeing pretty stagnant growth as well, so that engine's also turned off. And the same is true in the UK. So really the only driver of global growth that's really still kicking away and driving through for the moment is the United States. And that's something that we think over the course of 2024 may change. We may see a further slowdown in growth, and that deceleration is something that would be good for government bonds. And in addition, we see further deceleration in inflation, a move much closer to target. And so when it comes to rate cuts, we think many of the central banks in the developed world will be cutting interest rates quite meaningfully through the course of 2024. And there's certain shocks that may materialize through that period of time that may accelerate those moves as well. One market where we think we have a very differentiated view is the euro area. We think that the cuts should have already started. We believe that euro area growth is 0 to slightly negative already. And when we look at inflation, yes, the year-over-year numbers are still slightly above target, but if we look at shorter-term measures like the 9-month annualized CPI or 6-month annualized CPI, they're actually well below target. The 9-month annualized CPI is at 1.7%, but the 6-month CPI annualized is actually negative 0.6%. Right? So we're already experiencing deflation on a short-term basis in Europe, and that's why we think that they should be cutting rates already. In Australia, we've already had some volatility in their payrolls data. The consumer has quite a lot of debt, and the housing market is quite levered. And we think that given the ties to China via exports, about 40% of Australia's exports go to China, that actually they may have to cut as well, but that might come a little bit later in the year. So we think we'll see rate cuts across all of those regions. Primarily, we think it'll be the US, the UK, and the euro area that are leading the charge there.
Well, thank you for all your insights on US, across Europe, UK, and Australia. So I guess we have been seeing quite a bit of adjustments in yields recently. So I'd just like to get your thoughts. What is your strategy's positioning for duration moving ahead?
As you might have been able to tell, we're quite constructive on duration. We think that we're at the beginning of a rate cutting cycle in the developed markets. And typically, through a rate cutting cycle, you see quite a lot of capital appreciation in the bonds that you own on top of the income that you receive. And so we think it's going to be a real tailwind to client portfolios and also the Dynamic Bond Fund over the course of the coming years. With regards to the duration positioning, the main exposures that we have in the fund, of course, are to the US, but we also have exposure to places like Australia, New Zealand, the UK, even South Korea. Those government bond markets, in our view, present the best opportunities. They're all very high quality. They've got high ratings, but we also believe that they have rate cuts that are about to begin, and that should deliver some nice returns to our investors.
That's great to hear. So I noticed that global corporate bonds remain a key part of your portfolio. So I'd like to ask, are there any specific sectors or geographical areas that Jupiter Asset Management is positive on?
Absolutely. First and foremost, credit is a bottom-up process. So yes, you can have a look at top-down measures, but we spend a lot of time looking for those opportunities across all different markets, and we find some in each different region. But when we look at those high-level metrics, one of the things that I would mention is that US credit in particular, whether that's investment grade or high yield, looks pretty expensive on a historic basis. If you look at triple Bs, double Bs or single Bs, they're really in the kind of 10th percentile kind of area over the last 25 years, which is not giving you much margin of safety. Conversely, if you look in the UK or you look in the Euro area, you're actually seeing those percentiles sit at much wider levels. Kind of in the 35th to 45th percentiles over time. So you're getting a bit more cushion, you're getting a little bit more spread for the same type of quality of business. And when we think about the specifics of that, it's not just a case of, well, we think that that's attractive and therefore we allocate to the whole market. We're specifically picking the spots that we think are the most interesting. And the bits that we think are the most interesting are defensive allocations to credit. And there's three elements to our defensive allocations to credit. We're looking for short-dated securities at this moment because valuations are expensive. That lowers the volatility of the fund. We're looking for defensive sectors. We believe that we're sitting at the late stages of the cycle. That will be things like pharmaceuticals, telecoms, consumer staples. And we're also looking for first lien senior secured bonds. And these sit right at the top of the capital structure, and it means that we think they should exhibit lower volatility than many others. And so actually, when we look at our asset allocation today, we're getting some really nice yield from credit, but we're not trying to impart a lot of beta into the fund and a lot of volatility from that. We want it to be defensive carry. And that might sound boring, but actually at this point in the cycle, boring is pretty good.
Okay, that's good to hear. So I also noticed that your fund has a relatively large exposure to high yield issuers. So how do you feel these high yield issuers will perform in 2024?
As I mentioned, we're late cycle in terms of where we sit in the business cycle. And what that means is we have to be very careful with credit selection. And when we look at our top-down macro view, that's fully incorporated when we're thinking about allocating to credit. And these credits and these positions must be able to stack up in the environments that we're considering. And so our credit allocation at the moment to high yield, on a notional basis, is about 39% of the fund. But actually, when you include our hedges that we have in the strategy, it drops to just a little bit above 30%. So we're hedging out some of the beta to try and make the portfolio more defensive, and that allows us to play for alpha. And just touching on the question before, we're using those three levers of defensive characteristics within that market, short-dated, defensive sectors, first lien senior secured, to allow us to capture yield. And the final thing that I will say there is that we're trying to target bonds that are going to redeem early. And so actually 50% of that asset allocation to those markets with high yield ratings has a call date or a maturity in the next 12 months. Now, all of them might not mature or they might not be called over that period of time, but our expectation is that at least 50% of that 50% will be called. And that would reduce that asset allocation to high yield by about 10% over the next 12 months if we don't do anything. And that's an approach that we often use when it comes to late cycle investing, as it gives us the choice when that capital returns to us, how we want to reinvest it, how we think about valuations at that point. And that internally generated liquidity is quite a powerful tool when we think about some of the risks out there as we transition, in our view, probably from a soft landing agenda that seems to be prevalent in markets, potentially with increasing risk that we move into a hard landing scenario later in the year, if not into 2025.
With that, we have come to the end of today's feature episode with Harry Richards from Jupiter Asset Management. Thank you for your insights on both the fixed income asset class as well as the Nikko AM Dynamic Bond Fund, and we hope to have you back soon.
Thanks for having me, and goodbye.